Hello, everybody. I hope everybody's doing fine. I'm recording this on December 27th, 2021. This is my third lecture on from Module 5 on the source of income. And let's talk about the sourcing of rents and royalties. This is covered in section 73.5.1. As Professor Loken indicates, rents from the lease of tangible property have their source where the property is located. This is provided for in 861A4 and 862A4. Royalties from the licenses of intangible property are assigned to where the intangibles are used. Again, the site is 861A4, US side, 862A4, foreign side. Royalties from licenses of intangible property are assigned to where the intangibles are used, as I said. For example, as Professor Loken notes in 73.5.1, first paragraph, royalties for the exhibition of movies have their source in the place of exhibition, not where the films were produced. The rule of sections 861A4 and 862A4 embraces all classes of property, real, personal, tangible, intangible. In short, any asset in which the transferable rights can be identified, whether arising by law, custom, or circumstances, and embraces leases, licenses, rentals, and the like. 861, 862A4 are not limited to assets which rights are legally protected. In some cases, as we know, with know-how, for example, the simple fact of exclusive possession of an asset by one person makes it possible to demand a return for its use by another, and that would be covered by 861A4 and 862A4. In distinguishing sales from licenses, in general, the transfer of all substantial rights and intangible would be treated as a sale. For example, the exclusive right to use a patent for its legal life in a particular geographical area, country, would be a sale. In other words, a transfer of rights under a copyright or patent or the like is a sale if the property owner grants to another the exclusive right to exploit the property in a particular medium or jurisdiction throughout the life of the copyright or patent or whatever in return for consideration. On the other hand, if the property owner transfers the right to exploit the property for a period less than its remaining legally protected life, the transaction is a license for tax purposes, and the property owner's income is sourced under the royalty source rules of 861A4 and 862A4. As you'll learn when we study section 865D, and I may try to get it done as part of this lecture. We'll see how it goes. Even if the transaction is treated as a sale rather than a license for tax purposes, when the transaction involves an intangible, 865 little d in parenthetical, 1 in parenthetical, cap B in parenthetical, applies the royalty source rule to payments that are contingent on the productivity, use, or disposition of the intangible. What do I mean by productivity on the use of the intangible? If the sale was for consideration, paying 4% of sales, that would come within this provision. Let's now focus on the sourcing for gains in the sales of property, which is discussed in your book in section 73.6. Let's start off with a fairly easy concept. and that is the gains on the disposition of U.S. real property interest is U.S. source income, whereas gains on the sale or exchange of real property located outside the United States is foreign source income. And that's provided for in 861A5 and 862A5, but that could also be intuitive, I suppose. 861A5 assigns U.S. source to all gains, profits, and interest from the disposition of United States real property interest. A United States real property interest, in turn, is a term of art defined in Section 897C to include, along with all directly owned real property, holdings of stock and non-publicly traded domestic corporations with substantial ownership of U.S. real property. Section 861A5 therefore assigns U.S. source to gains from the sales of shares in many non-publicly traded U.S. corporations, which have at least 50% of their assets in real property, along with 861A5 also would cover, obviously, a situation where there's an actual sale of U.S. real estate. Again, if the real estate was located in the U.S., it would be U.S. source. Located outside the U.S., it would be foreign source. So 861A5 and 862A5, conforms to the conventional view that real property has an affinity to the country of its location. As I said, it's fairly intuitive. The next topic I want to discuss is the sales of inventory. As Professor Loken notes in 73.6.3, first full paragraph, the source of income on the sale of inventory or other personal property held for sales to customers in the ordinary course of business depends on whether the taxpayer acquired the goods by purchase or produced the goods itself. So there's a clear distinction here. Let's talk first about sourcing of inventory acquired by purchase. Generally pursuant to 861A6, little a in parenthetical, 6 in parenthetical, and 862 little a in parenthetical, little 6 in parenthetical, income on the sale of inventory of property acquired by purchase has its source in the country in which the sale occurred. So it's for purchased inventory. And we're talking about taxpayers functioning, say, as retailers or distributors who didn't produce the inventory itself, but purchased it from somebody else. You look to where the sale occurs. Inventory is broadly defined to include stock and trade and any other property held for sale to customers in the ordinary course of business. All these sections that I refer to, you should read. So, please read on your own 861A6 and 862A6. Income from the purchase and sale of personal property, which is covered by 861A6 and 862A6. That is, it deals with pure selling, such as retailing and wholesaling forms of distribution and marketing that are ends in themselves, as opposing to selling that arises in as the culmination of some other economic activity, such as manufacturing or processing the products, is governed by 861A6 and 862A6. So again, for sourcing rules, there's a clear distinction between taxpayers functioning just as sellers and taxpayers who are both produced and producers are broadly defined and sold the inventory. Although the statute does not literally say so, gains from the purchase and sale of inventory property entirely inside the United States are also U.S. source income. Conversely, gains from the purchase and sale of inventory entirely outside the United States have foreign source income. What's clear, and the statute does not as clear as it should be. But 861A6, stands for the proposition that the only activity one looks to in terms of sourcing of inventory that was purchased is where the sale occurs. It doesn't make any difference, where the property was purchased. That's totally irrelevant. The entire gain from the sale of inventory takes its source from the place of sale. Indeed, the universal shorthand among tax professionals to describe the rule is place of sale governs the source of income. As Professor Loken notes, I think I'm in 73.6.4, an exception to the place of sale rule for inventory property acquired by purchase is contained in 865 little e in parenthetical and 2 in parenthetical. That is, in general, under this provision, a non-resident, and non-resident is going to be resident, non-resident is specifically defined for purposes of 865 and 865G. We'll come back to that. But in general, income on a non-resident's sale of inventory property is from U.S. sources, regardless of place of sale, if the income is attributable to an office or other fixed place of business of the taxpayer in the United States. There's an exception to this exception. This is contained in 865 E2B. Pursuant to section 865, little e in parenthetical, 2 in parenthetical, cap B in parenthetical, this deemed U.S. source rule for income attributable to an office or other fixed place of business of a taxpayer in the United States does not apply to any sale of inventory property which, one, is sold for use, disposition, or consumption outside the United States, and two, if an office or other fixed place of business of the taxpayer in a foreign country materially participated in the sale. Professor Loken notes that 865E2 can apply to gains on the sale of personal property other than inventory. I want to point something out to you because there's a mistake that has not been corrected. And dealing with 865E2, this is 73.6.4. I'll read and I'll tell you where the mistake is. It's a typo, but it just, you can, very, very confusing because of the typo. Professor Loken writes, generally, income or gain of a non-resident disposition of personal property is from U.S. source if, one, the taxpayer is an office or other fixed place of business in the United States, and two, the income or gain is attributable to the office. For purposes of this rule, a non-resident is a foreign corporation or individual, whether U.S. citizen or alien, whose tax home is, and you've got to insert the word not in the United States. I'm not sure why they haven't caught this. The rule can apply to income or gain on the sale of personal property of any character, including inventory and depreciable property. Of course, you know, they update the electronic version of the text a few times during the year, and maybe they'll catch it between the time I'm recording this lecture and you listen to it. I just wanted to also bring to your attention 73.6.4.2, items attributable to a U.S. office. Let's just read that. And an item of foreign source income, a gain or loss attributable to a non-resident U.S. office, if the office is a material factor in the production of the item and regularly carries on activities of the type from which the item is derived. Activities of an office are a material factor if they provide a significant contribution to by being an essential economic element in the realization of the income, gain, or loss. An office can be a material factor without being a major factor in the item's realization. The activities of each of two or more offices, e.g. a U.S. office and a foreign office, can be material factors. The application of 865E2 can get complicated where the inventory was produced by the taxpayer. There were 2020 final regulations, Treasury Decision 9921, that discusses this. I'm not going to hold you responsible for it. I did upload a very good summary of these regulations. Again, I won't test you on it, produced by your firm, produced by Ernst & Young, which I've put, it should be on your class's website. In 73, 6.3.3, and let me get in front of me too. Professor Loken reproduces regulation 1.861-7, little c in parenthetical. Let's read that. Excuse me. A sale of personal property is consummated at the time when and the place where the rights, title, and interest of the seller in the property are transferred to the buyer. Where bare legal title is retained by the seller shall be deemed to have occurred at the time and place of passage to the buyer of beneficial ownership and risk of loss. However, in any case in which the sale transaction is arranged in a particular manner for the primary purpose of tax avoidance, the foregoing rules will not be applied. In such cases, all factors of the transaction, such as negotiations, the execution of the agreements, the location of the property, and the place of payment will be considered, and the sale be treated as having been consummated at the place where the substance of the sale occurred. As Professor Loken notes, however, the courts have consistently held that a sale occurs where title, together with certain indicia of beneficial ownership, pass to the purchaser. And he cites a case called Balanovsky, which I think is cited in, I think it's footnote 51. Hence, the source rule for income from the sale of inventory property had come to be referred to as the title passage rule. Importantly, place of sale only applies to purchased inventory, not to inventory produced by the taxpayer as a result of changes made by the Tax Cuts and Jobs Act to Section 863 that we'll come back to. The courts have generally found that title passes under the law of sales at the place where the parties intended to pass, either as expressly stated or as evidenced by their actions. The rules of the Uniform Commercial Code are looked to. A contractual recitation of where title passes generally will be determinative of place of sale for tax purposes, sourcing purposes, assuming legal title and at least some significant indicia of beneficial ownership. For example, risk of loss coincide. For example, in a case called AP Green Export Company, the Court of Claims held that since the contract expressly stated that the seller retain title to the goods and responsibility for their shipment and safe carriage. The income was foreign source. Until they retained responsibility until it arrived at the location of the customer. As Professor Loken notes, and I think he's in 73.6.3.3. I think it's the next to last sentence. The IRS, while the regs permit the IRS to attack title passage and tax avoidance situations, Professor Loken points out this is really left to egregious arrangements, and there are few reported decisions that have assigned income to domestic sources when title passed outside the U.S. And he gives some sites in site 50, footnote 51 in 73.6.3.3. So as I said, the courts have repeatedly held the title passage rule may be used with deliberate tax purposes in the absence of sham transactions. And see, for example, Loken's discussion of a case called Commissioner B. Fowler Inter-American Corporation, cited in 73.6.3.3. It's footnote 50. Again, these rules were very, very important before the Tax Cuts and Jobs Act for taxpayers who both produced and sold the inventory, because under pre-2018 rules, you were able to split sourcing between place of manufacture and place of sale. That is no longer true. So place of sale only applies with respect to taxpayers who are not producers of the inventory. They function as retailers or wholesalers, distributors, not producers. So let's turn, in fact, now to the rules post Tax Cuts and Jobs Act. These rules apply 2018 forward to goods that are manufactured or produced by the seller. So let's read in your textbook 73.6.3.2, goods manufactured or produced by seller. So Professor Loken writes, for taxable years beginning after 2017, gross income on a sale of inventory property produced by the taxpayer is from sources in the country or countries in which the taxpayer produced the property. And this is the last sentence of 863B. The term produced includes, and very broadly defined, manufactured, produced, created, fabricated, extracted, processed, cured, or aged. So, for this purposes, if you're aging bourbon in Kentucky in the United States, that is considered to be produced. Only production, going back to the text, only production activities conducted directly by the taxpayer are considered for this purpose. And I'll talk about that. I'll give you an example of that in a moment or two. He goes on to write in the second paragraph of 73.6.3.2, for taxable years beginning before 2018, gross income on a U.S. sale of goods produced by the taxpayer outside the United States, or a sale outside the United States of goods produced in the United States, is from sources partly within and partly without the United States. The pre-2018 regulations describe two methods that may be used for allocating or apportioning income from these transactions between the place of manufacture and the place of sale. A 50-50 method I mentioned before, 50% the place of manufacture, 50% place of sale, or an independent factory price method. Let's jump to the next paragraph. Congress enacted the new rule in 2017, which which says basically the source is based on where the assets used to produce the inventory are located. So Congress enacted the new rule in 2017, incident to its enactment of participation exemption. You're talking about 245 Cap a dividend receipt deduction for domestic corporations, allowing at least 10% of the stock of a foreign corporations, replacing an indirect credit previously allowed to these corporations as old 902. In recommending the new rule, the House Ways and Means Committee recognized that the pre-2018 rules, particularly the 50-50 method, effectively operate as a subsidy to American companies exporting goods to other countries, which Congress allowed only because of the perceived inadequacies of the credit system. I'll let you read the quote in your book that follows. Again, in the old rules, and when I was VP of Tax at Unilever US, we certainly took advantage of that. We made sure that we had title passage outside the United States on goods that were produced in the United States and sold abroad in order to be able to, under the then current rules, source 50% of the inventory as foreign source. That was particularly important when a deemed paid or indirect credit was allowed under old section 902. And again, one of the problems of using credits, especially the deemed paid credit under old section 902, was meeting the requirements of having sufficient net foreign source income under section 904. So if you're able to generate additional gross foreign source income by title passage, allowing you to use 50% of the income from the inventory sale on items produced in the United States, that was great because it at least in my situation and for many of many US-based companies, it enabled them to use a lot more credits than they would be able to use otherwise. But again, the rule in 863B today is you look to where the assets are produced. I just want to, let's just read the sentence in the code for a second. So, if you look at 863B, and I'm reading the very last sentence, gains, profits, and income from the sale or exchange of inventory property described in paragraph 2 shall be allocated and apportioned between sources within and without the United States solely on the basis of the production activities with respect to the property. So this is a major, major change made by the Tax Cuts and Jobs Act in late 2017, effective in 2018. By the way, there's a lot of material in 73.6.3.2, dealing with the old rules and the pre Tax Cuts and Jobs Act rule, and please don't be confused. Again, the rule today is where the taxpayer both produces and sells. You look where the assets are located that are used in production, and I will elaborate about this shortly. In terms of where goods are produced, you only count assets used by the taxpayer and not production assets of a contract manufacturer. That's really important. Let me give you an example. My old company, Unilever United States, we used to own a company called Calvin Klein Cosmetics. It produced perfume. Some of the perfume we manufactured in the United States, by Calvin Klein. Others we had it produced by third-party contract manufacturers. And so when they were produced by a contract manufacturer, we were not under the statute and the regulations, we're not considered to be a producer because we're not doing the production. A contract manufacturer is. So you know, the way you'd look at it is you'd look at it based entirely on where the sale occurs. So if you have goods produced by a contract manufacturer that uses their own equipment, the taxpayer is not considered to produce the equipment, produce the inventory, I'm sorry. Instead, the taxpayer is viewed as just like a retailer or a distributor. And so sourcing is based on where the sale occurs. This particular, back then we were on the old 50-50 rule if we were producing, but again, the 50-50 rule is gone today. So if we had this fact pattern today, we had this fact pattern today, 100% of the sourcing of the goods would be, would be foreign source if we sold it outside the United States. And these particular goods were sold outside the United States. That was the rule way back when, and the rule today, because you only count the taxpayer producing assets that it itself produces with its own equipment. I hope that's clear. Again, as always, email me with questions. And again, I'm hoping to have some sessions where we could communicate synchronously, so that you can ask questions and I can see whether you understand what's going on. Since for inventory produced by the taxpayer, sourcing depends on where the production assets are located, it is first important to define what production assets are. Listen carefully to what I'm saying. Under the regulations, production assets include only tangible and intangible assets owned directly by the taxpayer that are directly used by the taxpayer to produce inventory, and do not include assets that are not directly used to produce inventory. More specifically, under the regulations, and it's 1.863-3C regulations, production assets do not include such assets as accounts receivable. So accounts receivable would not count. Intangibles not related to production of inventory, like trademarks, would not count. Copyrights would not count. Marketing intangibles would not count. Customer lists, trademarks don't count. Transportation assets, taking you from the factory somewhere else to a warehouse, would not count. Warehouses don't count. The inventory itself would not count. Raw materials would not count. No work in process, none of that would count. In addition, production assets do not include cash or other liquid assets, including working capital, investment assets, prepaid expenses, or stock of a subsidiary. So if I were to give you an exam, a fact pattern, where I would list non-production assets, that's a red herring, you ignore it. What happens in situations where we've got some assets located in the United States and some assets located outside the United States, and there we have to bifurcate sourcing. We'll see. We look to the average tax basis of the assets, but before we get there, let's hone in on where are assets located, considered to be located for tax purposes. Well, tangible assets, I think that's easy. They are where they are, right? If an asset like a manufacturing plant is located in a Canadian branch of a US company, it's located in Canada. If it's located in the state of Pennsylvania, United States, it's considered to be US, right? Um, what about intangible assets? Um, with respect to intangible assets, they're considered located where the tangible production assets owned by the taxpayer, which it relates, are located. What am I talking about? Suppose you've got a patent that deals with a manufacturing process, and it deals with the manufacturing. The patent involves a Canadian branch's manufacturing process. So it's used by the Canadian factory. So the intangible would be considered located in Canada. I hope that makes sense. Again, you can always email me with questions, or we have these sessions, ask me directly. So an easy case, if all the production assets are located in the United States, everything is considered US source. Located outside the United States, everything is considered foreign. Where the taxpayer's production assets are located both within and outside the United States, the income attributable to production is apportioned to different sources according to the average basis of the production assets. So it's the foreign source income is determined in general by the ratio of production assets located outside the United States to all production assets. And this is under these 1.863-3C regulations. Generally, you use the average adjusted basis beginning and ending of the year, unless there's some sort of distortion by virtue of a major acquisition or disposition, and then you'd have to fine tune it. In terms of measuring an asset's basis, and again, you don't look to their fair market value, you look to their tax basis. Under the final 2020 regulations, you measure the assets US basis using an alternative depreciation system, or ADS. Not sure if you studied that in other courses, but that will generally give you a higher basis, because you're not using straight line rather than accelerated depreciation. So let's do an easy example. Let's suppose T manufactured and market a particular widget, and its tax basis using ADS for equipment in the United States manufacturing the widget will average $6 million, and $4 million was the average tax basis of the assets located in Canada. Then 60% of the income from the sales of the inventory would be US source, and 40% foreign source. I hope that's clear. I just want to point something out in 73.6.3.2, where Professor Loken talks about the allocation and apportionment of expenses against gross foreign source income. So it's an important point. What we've been talking about in Module 5 is the sourcing of gross foreign source income. In terms of foreign tax credits, say you look to net foreign source income. To go from gross to net, you've got to allocate and apportion expenses against gross foreign source income. Professor Loken has a chapter 73 cap A devoted to it. I'm not sure we'll get through it in this course. But, on your own, if we don't touch on it, you should, take a gander at 73 Cap A, talking about the allocation and apportionment of expenses. Again, when we're talking about withholding tax, for DAP withholding tax, 871, 881, we're talking about gross income. But under 904, and we'll come back to 904 when we talk about foreign tax credits some more in module 6. We're talking about net foreign source income. I think I mentioned earlier in the semester, and probably part of the introduction, that for most U.S. corporations to use credits, you've got to have it's up to 21% of net foreign source income. If you don't have that, you won't be able to utilize credits. So again, gross foreign source income is a starting point in many cases to get to net foreign source income. Let's talk about 865A and sources tied to residence. Pursuant to section 865 little a in parenthetical, in general, income from the sale of non-inventory personal property is sourced according to the residence to seller. There are going to be many exceptions to that, but that's the general rule. So 865 little a in parenthetical states the general rule that income from the sale of personal property, one, by a United States resident shall be sourced in the United States, or two, by a non-resident shall be sourced outside the United States. Let me get a drink of water. The basic principle here in 865 little a in parenthetical is that gains from the sales of personal property take their source from the place of residence of the seller. The numerous qualifications of this rule, it turns out, are more important than the rule itself, which applies mainly to pure investment assets. Under 865 little a, as Professor Loken notes in 73.6.5, first paragraph, neither the place of sale nor the place of the taxpayer's activities with respect to the holding or sale of the property is relevant. So when 865A applies, you look to the taxpayer's residence. 865B provides that sourcing of inventories is accepted from the general sourcing rules of 865A. And we've talked about inventory. That's going to be covered by 861A6, 862A6, and 863B. It's not covered by 865A and 865 little b in parentheticals, so it tells you. Let me explain a complication in section 865G. 865, that's 865G, which contains a special definition of residence for purposes of section 865. So we studied individual residence, recall earlier in the semester in 7701B, but there are special rules, particularly with respect to individuals in 865G that govern 865 and 865 alone. 865G defines a U.S. resident as an individual, U.S. resident individual as any U.S. citizen or resident alien with no tax home outside the United States, or two, any non-resident alien with a tax home in the United States. In other words, for an individual, in general, the key is where is the tax home located? And remember, we talked about tax home. It came up in 911 D3. It was also We also cross-reference 911D3 and 7701B. But tax home is generally one's place of employment or principal place of business. With a proviso that you can't have a foreign tax home if you've got a U.S. abode. That's the second sentence of 911 D3. But again, 911, the rules under 162, 162 provide that you look to principal place of business or place of employment for determining residence. For determining tax home, determining tax home. And tax home is critical in terms of residence for individuals under 865G. And so let's read, let's do the easy part. We'll come back to individuals. Loken points out in 73.6.5.1 that domestic corporations are U.S. residents for purposes of 865, and foreign corporations are considered to be non-residents under 865G. These are the same rules that we've had in general, right? This is no different. Individuals, as we said, are different. And let me get Loken's text in front of me. Hold on one second. So I'm in 73.6.5.1 second. Let's do the first paragraph first. Domestic corporations are U.S. residents for purposes of Section 865, as are non-foreign estates and trusts, but all other corporations, estates, and trusts are non-residents. Any gain of a domestic corporation, estate, or trust subject to 865A is thus from U.S. sources, regardless of any connection the gain might have to the United States. As I said, individuals, it's different. Let's look at that second paragraph in 73.6.5.1, second paragraph. For purposes of Section 865, individuals are residents of the country in which they maintain their tax homes. A person's tax home is at a particular place if expenses incurred in traveling away from the place of business are deductible under Section 162, little a in parenthetical and 2 in parenthetical. Again, we studied that when we were covering 9/11. Accordingly to the regulations, an individual's tax home is located at his regular or principal if more than one regular place of business, or if the individual has no regular or principal place of business because of the nature of the business, then his regular place of abode in a real and substantial sense. A U.S. citizen or alien who is a U.S. resident under the general residence test of 7701B is nevertheless not a U.S. resident. This is important for purposes of 865, is if his or her tax home is in a foreign country. That's the key point that I'm trying to make. It is thus possible for an alien to be a U.S. resident for all other U.S. tax purposes, but a non-resident for purposes of Section 865. Conversely, an alien who is not a U.S. resident under 7701B, but as a tax home in the United States, is a resident for purposes of Section 865. There's a proviso, a further qualification contained in 865G2. Under 865, little g in parenthetical, 2 in parenthetical, U.S. citizen and resident aliens shall not be treated as non-resident with respect to any sale of personal property unless an income tax equal to at least 10% of the gain derived from such sale is actually paid to a foreign country with respect to that gain. In other words, individuals connected to the United States, either by citizenship or residence, regardless of their economic center of gravity, that is their tax home, must assign U.S. source to gains from sale of property in tax havens. And again, they define tax havens as jurisdictions in which the gain is not taxed of at least 10%. And this is 865, little g in parenthetical, 2 in parenthetical. Professor Loken has an example of this in 73.6.5.2, last sentence. Let me get it in front of me. For example, if a U.S. citizen lives and works in a foreign country, gains on sales of securities are U.S. source income, even if the securities are issued by companies residing in the taxpayer's country of residence, and the gains are realized in transactions taking place in that country, unless the residence country or some other foreign country taxes the gains at a rate of at least 10%. Professor Loken notes in 73.6.5.1, third paragraph, a partnership is neither a resident nor a non-resident for purposes of Section 865. Partnership income and gains subject to Section 865 has no source characterization in the partnership's return, and each partner separately applies 865 to the partner's distributed share of these items. For example, when the residence rules applies to a partnership's gain and the distributed share of the item allocated to each partner residing in the United States is from U.S. sources. Okay. Let me just check where we are. Okay. I want to now focus on 865C, which deals with the sales of depreciable tangible property. It's covered in your book in 73.6.5.3 under the caption, italicized caption, depreciable property. Pursuant to 865, little c in parenthetical, 1 in parenthetical, generally the portion of the gain derived from the sale of depreciable property, sale or exchange of depreciable property, depreciable personal property, that represents depreciation recapture, is where the depreciation is where the depreciation reduced income. For example, if it reduced income in a Canadian branch, the recapture would be foreign sourced. Recaptured in the United States, it would be U.S. source. If the gain, this is 865C, little c in parenthetical, 1 in parenthetical, if the gain exceeds depreciation deductions, the excess has its source as if the property were considered to be inventory. So for purchased inventory, we know the rule is where the sale of the inventory takes place. So it's where the sale of the depreciable, personal property takes place. That's for purchased inventory. I believe, although it's not covered in the Loken book, and I'm not sure I saw it anywhere else, specifically in the regulations, I believe that if the depreciable tangible property were produced by the taxpayer, then you would follow the rules of 863B, and you would look to where the production took place to determine the sourcing of gains that exceed depreciation recapture. So the first segment of the gain, again, on the sale of depreciable personal property, the recapture amount is split between U.S. and foreign sources, bearing the same proportion for which the depreciation deductions were allocated. This is provided for in 865, little c in parenthetical, 1 in parenthetical. This is done by constructing a fraction. The numerator of the fraction is the sum of depreciation on the property that was allowed in determining taxable income from sources within the United States. The denominator is the source of all depreciation allowed with respect to the property in determining taxable income from both domestic and foreign sources. The U.S. recapture amount multiplied by the fraction is gained from U.S. sources, and the remainder of the recapture amount is gained from foreign sources. So I'd like you on your own to read 865 C1, C2, C3, and C4. Pursuant to 865, little c in parenthetical, 2 in parenthetical, gain in excess of depreciation recapture from the sale of depreciable tangible property should be sourced as if the property were inventory property. Therefore, if it's purchased equipment, the place of sale, and the place of sale is outside the United States, the gain in excess of recapture is going to be foreign source. I believe, as I indicated, that if the property is self-constructed by the taxpayer, that if you literally follow the statute, you would look now to 863B, and the source in excess of recapture would be based on where the production took place. Let's read 73.6.5.3, first paragraph. Let me get a drink of water. So Loken writes in 73.6.5.3, the place of resident rule does not apply to gain on a disposition if depreciation deductions have been allowed with respect to property for U.S. tax purposes. Such a gain is divided between 1, an amount equal to the aggregate of the depreciation deductions allowed in determining U.S. tax, or if less, the entire gain, and 2, any excess of the gain over depreciation deductions. The gain up to the amount of the depreciation has the same source characterization as the income against which the depreciation was deducted. For example, if 60% of the depreciation allowed for a particular property was deducted from gross income from U.S. sources, then 60% of the gain, or of less gain equal to 60% of the depreciation, is also U.S. source income. If the gain exceeds the depreciation deduction, the excess has its source at the place of sale. And again, I think what Professor Loken is alluding to is assuming this tangible personal property, depreciable personal property, was acquired by purchase. I don't think that is correct with respect to self-constructed property by the taxpayer. Let's do simple examples illustrating how 865C works. So let's suppose we have taxpayer named T. It acquires depreciable equipment for $2,000 on 1/1/2017. And it could be an individual, it could be a corporation. It doesn't make any difference. So he acquired the property on January 1st, 2017. Between 2017 and the end of 2021, he claims, or it claims, $1,000 of depreciation deductions, of which 600 offsets U.S. source income, and 400 offsets foreign source income. Everybody understand that? So he bought the equipment for $2,000. It's purchased equipment. He took 1,000 of depreciation during 17, 18, 19, 20, and 21. His adjusted basis, or its adjusted basis, is now 1,000. And suppose in my first example, he sells the equipment for $2,000. Since 600 of the depreciation reduced U.S. source income, then 600 of that gain, the difference between 2,000 amount realized and the 1,000 adjusted basis, is U.S. source income, and 400 is foreign source income. That's the amount that reduced foreign source income from depreciation. Let's change the example a bit. Same years, but instead of selling the equipment for 2,000, let's sell it for 1,500. The gain is 500, right? Amount realized 500, adjusted basis 1,000. We're going to ignore selling prices, selling cost for this purpose, selling expenses for this purpose, because 60% of the depreciation offset U.S. source income, then 60% of the 500 of gain is U.S. source. So 300 is U.S. source, and the other 200 is foreign source, because 40% of the depreciation had reduced foreign source income. Hope that makes sense. Let's add a third wrinkle. Let's suppose in this example, where the basis is now 1,000, and there had been 1,000 of depreciation, the original cost was 2,000. We sell this equipment for 2,500. There is now 1,500 of gain. The first 1,000, the difference between 1,000 and $2,000, we said is 600 U.S. source, 400 foreign source. That relates to the source of the depreciation itself. Remember, 600 reduced U.S. source income, 400 reduced foreign source income. The other 500, because it was purchased equipment, it's sourced like inventory, we look to where the sale occurs. If the sale occurs outside the United States, then the other 500 is foreign source. If the sale occurs in the United States with a U.S. customer for use in the United States, it's U.S. source. To reinforce what we've learned, let's read from your book. I'm in 73.6.5.3, and I'm in the fourth paragraph. So again, I should read all the material in the text relates to what we're covering. I'm not going to read everything. I'm just highlighting things that I think are important. And so in that fourth paragraph of 73.6.5.3, Professor Loken writes, assume T sells equipment used in its business at a gain of 500 in a transaction in which title to the equipment passes to the buyer in foreign country X. If T was allowed 400 of depreciation on the equipment for U.S. tax purposes, the recapture rule determines the source of 400 of the gain, which is from U.S. sources. If T used the equipment exclusively in the United States, and all depreciation has been deducted against income from U.S. sources. In contrast, the depreciation deductions were allocated 75% to the U.S. source income and 25% to foreign source income. 300 is income from sources in the United States. 100 is from foreign sources. The 100 excess of the gain over the sum of depreciation deduction is from sources in country X where the sale occurs. Again, I think what Professor Loken is referring to is assuming the equipment has been purchased. If it's self-produced, the statute seems to suggest that you would look to the rules under 863B, which is where the production took place for determining sourcing for a gain in excess of depreciation. Okay. Beginning in 73.6.5.3, Um, I think I'm in the second paragraph. Professor Loken notes that pursuant to section 865, little c in parenthetical, 4 in parenthetical, cap B in parenthetical, the depreciation with respect to the property consists of all depreciation deductions reflecting the property's adjusted basis, including one, depreciation taken on the property whose adjusted basis was transferred to the property in some prior non-recognition transaction. And 2, depreciation of property taken by a prior owner whose basis carried over to the taxpayer. What does he mean by depreciation taken on property whose adjusted basis was transferred to the property in some prior non-recognition transaction? It could be, like-kind exchange. Since 2018, under Section 1031, which you may have hopefully studied in another course, since beginning in 2018, the 1031 like-kind rules only apply to real property, not personal property. But again, this could be equipment, a personal property, subject to a like-kind that occurred before 2018. Loken gives the following example in 73.6.5.3, second paragraph. Assume a seller recognizes gain on the sale of property asset 2 that acquired some years earlier in exchange of like-kind property. He's under, say, 1031, because the basis of the exchange property asset 1 was the foundation for the basis of asset 2, referred to as substituted basis. The depreciation taken into account on the sale of asset 2 is the sum of depreciation deductions allowed to the taxpayer with respect to assets 1 and 2. Similarly, on a sale of property that had been transferred to the taxpayer in a Section 351 exchange, both the transfers and the taxpayer's depreciation are taken into account because the transfer's basis carries over to the taxpayer and is referred to as carryover basis under Section 362A2. I think I'm going to stop here, and we'll pick up with intangibles in the final lecture of Module 5. Thank you. Have a good day.